Sanwu, welcome back to the Slice Pod, where we are gonna, I'm kidding. Like, it's been 3 seasons. That's crazy. A whole year and change of building Slice. We set out to tell the stories of emerging managers, what we call emerging managers. For some people, they're not even on the map. But we wanted to tell the story of these funds in a way that goes deep and gets context into their backgrounds and try to understand what's shifting in the venture landscapes through the lens and eyes of the people at the forefront of early stage. Before we get into this season's recap, let's start with some numbers. Let's give context to what we've done. What did this past year around the sun look like for us?
Yeah, we screened about 180 funds, reviewed 98 data rooms, and invested in about a dozen of those. These are all funds under 50 million. Most of the time, we're under 20 million, by the way. What we've learned from going through about 100 data rooms is that the best managers have two things, which is clarity and consistency. So clarity means that you can tell us your right to win in one clear sentence. It's not any generic thing like I can help with recruiting or I have a really strong network. Every other fund that we know says that. I feel like that's very, very standard.
If you don't have a strong network, probably this ain't the job for you. Let's start there, right?
Exactly. The managers who really get it get really specific. I'm a former founder. I've become the product founder whisperer for technical founders building enterprise AI. I'm sure you know exactly who I'm talking about right now. Or I'm the best first check for founders because I built Quora's monetization playbook. I run a GSV fellowship that allows me to see and back channel every single opportunity that comes my way. I'm sure you also know exactly who I'm talking about, and that specificity is super rare. On the other side, I think consistency means everything aligns for that manager. So fund size, check size, portfolio construction. If you've raised $50 million and you're writing 200K checks, maybe 35 plus companies, do you have the bandwidth for that? Are you solo GP, co-GP? What's the partnership structure? Or if you're on the opposite side of the spectrum, if you're a $10 million fund, a million plus checks, that's maybe 8 to 10 companies. Are you actually investing in really interesting companies? Are you making the right bets? The best managers have this genuine alignment between the two. They know what they're really, really good at and have a fund model that lets them deploy at that edge with consistency.
I think it's always obvious when it makes sense. And it's also painfully obvious when it doesn't. Mm-hmm. If there is a doubt, there is no doubt. In the absence of doubt, it's okay, this is why this makes sense. I can easily articulate it. To what you just said, it's interesting how the managers that have the easiest time to actually get these vehicles off the ground are the ones that have a clear and consistent brand. That it's not what they say, but what other people say about them when they're not in the room. Mm-hmm. And so what you were describing was obviously Vivek and Sarah, right? You don't need to know who they are. Right. I just need to tell you what it is. And then you're like, oh yeah, that's the manager, right? Mm-hmm. Everybody knows that. If you don't know where you fit in the landscape, you're probably not going to make it. The market has changed so dramatically over the last decade, but even over the last 2 decades, a lot of the venture advice, a lot of the idealization of what emerging managers looks like, the USVs and the benchmark, I want to build a fund like those ones and so on. Venture is a completely different game today than when Fred Wilson invested in Twitter. It couldn't be more different. YC famously introduced the safe note, which changed the landscape of early stage forever. We're not going back to priced first rounds. There is very little governance at the early stages. It's a much more collaborative game. Capital is basically frictionless. There is a more abundance of capital. There is more abundance of opportunities. Seed rounds are pretty much a commodity this day and age. Whether 10, 15, 20 years ago, they were still pretty rare. And so it was just a handful of firms competing on a handful of deals, which made it extremely easy for an LP to know who were the investors who had the best reach, essentially. Today, it's very different. There is a proliferation of early stage managers and founders, and it's really hard to capture alpha before it becomes obvious. And then to add insult to injury, 4 years after YC introduced the SAFE, SoftBank launched a $100 billion venture fund, which At the time, 84 billion was the total amount of capital deployed in 1 year across the entire venture landscape. And this guy shows up with a single fund that it's bigger than all the other funds put together in terms of deployment. Masa is not somebody that holds back. He was like, we got the money, we're going to spend it, and we're going to do it quickly. This created this insane level of competition for the best quality assets to drive prices up, inflation at the later stages, and also force the bigger funds to get bigger so that they could compete against Masa and against themselves. And now we have this very barbell situation where the middle basically collapsed. And while the middle collapsed, it creates a massive vacuum at the early stages, which we think it's a true opportunity for what we call first check investing. So a company raising $1 million worth of capital, all on safe notes, all from a number of investors, because they're trying to get to a place where it's not just one guy helping them out, but a collection of people with different superpowers coming around the table in the very critical 0 to 1 phase. You don't really need a board member. You need a village of individuals helping you out. What we're really interested in is this bifurcation at the macro level, where you have very early or very late. And within the very early, you have a subsequent bifurcation of managers, the ones that are true first check investors, where you can't put a constraint on ownership and target check size, and the ones that are trying to do the old seed playbook of like the 750K to $1.5 million lead check in like a $20 to $30 million valuation sort of round. The truth of the matter is that Sequoia will win that deal every day. There is no chance that a founder that knows what they're doing is ever going to go with a random fund just because they're friendly. It just doesn't happen. A lot of people are like, oh, but what about the signal? What if Sequoia doesn't follow? The best founders don't have that problem. The best founders get followed on. If you're not one of the best, it really doesn't matter. Nobody cares. In the pursuit of looking for the best opportunities, you either go before it makes sense for one of the tier 1 funds to deploy a check, which usually means caps that are in the sub 10 range, where for Sequoia, cutting a check, it doesn't make any sense unless it's a scout vehicle. The managers that we like are the ones that understand this very well. They don't try to lead anything. They just try to back the best at the early stages.
Yeah, that's definitely something reflected in the data we see. Managers think they're early, but they're very late. The best managers understand the game is at inception, being the true very first check. And you're right, like they are almost always former operators or founders who've lived that 0 to 1 experience themselves, building their own companies or being inside that hyperscale startup company. And they know what it's like and what it takes to make your first hire, land your first customer, figure out product market fit with 6 months of runway. And because of that, I think they become that first call for the founders, no matter what stage of funding they're at. It's not because they have the loudest or the biggest brand or biggest fund for that matter. It's because they can actually help and understand what the founder is going through. I think there's this misconception that ambition is tied to fund size, and it's really not. It's like a weird ego thing. I think the most ambitious managers that we actually see say that I'm going to be the absolute best at writing the very first check into this specific category with my specific skill set. And they size their fund to do that really well and not to maximize for AUM. And they have built incredibly happy and repeat customers, which are their LPs.
It's so obvious who is in it for the long term and who is in it because they work the math backwards from this is how much money I would like to make in a year. This is how big a fund I need to raise. And this is the strategy I'm going to have to employ to deploy that capital. It's a very banker's mentality, not a founder mentality. If there is one thing that YC taught founders well, is make something people want. Start with the customer and the market, and then work backwards into building something that is actually of need. And then if you do that well, you will be taken care of. You will be successful financially, you will be successful professionally. And financial and professional success are a consequence of doing something great and adding a lot of value to a given set of constituents. And so many of the managers that we talk to, they're just too flippy floppy about their fund size. And that becomes painfully obvious. Your fund size is your fund strategy, especially when you do something so small and focus on the early stages. You cannot deploy effectively as a solo GP $50 million as a first check investor. You're not going to buy quality assets at that scale. It takes a level of effort to build a reputation first and foremost, and then the level of relationship and the time that you spend with these founders. This whole thing with Slice, we started it because we don't have the time to spend with the founders at scale. We're reaching the point of diminishing returns where our direct portfolio, it's so large that it just doesn't, there's no time for new investments. If that is happening to us, imagine what an emerging manager is going through at the same time. The other thing, it's the clear right to win, what we talked about a second ago. I feel like sometimes the fund size is the right size, but it's so unclear. Why should people take money from you? That network angle of, oh, I know everybody. Everybody knows me. Okay, great. Everybody knows everybody. That's not enough. Why should a founder that knows what they're doing, because those are the best ones, right? Why would they call you at 10 p.m. bothering you and your family? Why would they pick up the phone? What is that you bring to the table that is so unique to you? And it's so special that it makes perfect sense. Very few people know how to answer that question. When you don't have a specific niche, you're telling me you're doing a better job than an institution like Sequoia at mapping the landscape. Like, you don't have that resources to do it. Like, it's impossible that you're seeing everything. But at least if you have some sort of filtering in place, I'm looking for Stanford graduates. I'm looking for B2B AI enterprise. I'm looking for industrial technologies at the early stages. If you have a clear flavor, and if that flavor matches your background, and if all of that matches the fund size relative to the stage you're investing in, then it becomes clear why you are a good fit for what you're doing. The best founders don't need capital. They can find money very easily. They need a specific kind of help, and they know what kind of help they need. And so if they will find somebody to give them capital, brings value before money any day, before they bring on somebody who just brings money. The founders that just raise capital for the sake of raising capital, and I've done that mistake myself, they don't know what they're doing. They're just conflating, similar to the manager that you were mentioning a minute ago, that conflates their success with the AUMs. They're conflating raising a large round to like being successful at running a business. That is not how it works. A large round is a consequence of running a good business, of having found a niche that scales. It's very different. It's very easy to spot the people that deserve to be supported from the ones that instead are just trying to pull a fast one. And, you know, the moment the tide will turn, they will also turn their attention to something else.
Yeah, we're looking for people that act with intention. I feel like Slice managers understand the game they're playing and build a fund model around that game, and then see if they can prove they can do it. Let's talk about what great actually looks like. We chose to do 11 interviews this season, 35 total from the beginning. Each one was designed to pull out something specific that other managers could learn from. For example, if you want to learn how to run a killer AGM, you should go listen to Sarah Smith's episode. She broke down the entire playbook of don't do the death march of metrics where you're just reading numbers at people for an hour plus. Make it more experiential.
We've been to a couple dozen AGMs over the last 12 months, and I would say that Sarah's is still the best experience of them all. Mm-hmm. And granted, obviously, an AGM like to the likes of an Andreessen or an Upfront, you can't, this is a different product. We're talking about 24 AGMs of emerging managers sub 50 million. And that death march is the hallmark of an emerging manager AGM. So it's just this very boring, very dull. The time never passed. At the end of the day, I'm just doing emails all the time, which is disappointing, which is sad. In the case of Sarah, it was a morning. We spent from 9 a.m. till 12 together, and it went in a blink of an eye.
Yeah. And I mean, it worked for her, right? Like more than half of her fund came in after that AGM that she put together, which with such detail, so thoughtful about everything.
It's an opportunity for you as a manager to showcase what makes you unique.
Yeah.
I'm not surprised that fundraise did so well post the event because it was such a great event. Every manager should put up a great AGM. It's not just a marketing tool. It's a way to actually tell the story of what you're doing differently. It's such a missed opportunity when it becomes an afterthought, because at the end of the day, this is an opportunity to engage with your customers directly and showcase your product to your customers directly. The thoughtfulness is not just a nice thing to have. Whenever you pick up a product that is built with intention, whether it's an iPhone or Sarah's fund, it's very confidence inspiring where every detail flows into the next. And it's a consistent experience across the board. Then I don't need to be in the weeds of every single investment that you ever made. We know when we see Sarah's check that that's who she is. It's very clear by the way that she brings together the entire experience, from the fundraising to the showcasing of materials to the AGM to talking about the individual investment that she makes and why she makes it. It's very thoughtful. And it doesn't feel like a sales process. There is a lot of folks that are really good at selling. They're really good bankers. And they're good at selling money on the founder side, and they're really good at raising capital on the LP side. That's what we call pure beta.
She's definitely the taste maker for AGMs for emerging managers and punches way above her weight in terms of what she did with that AGM. On another episode, if you want to understand what clear value add looks like, Vivek Sedera's episode is definitely the one to listen to. As we talked about earlier, he calls himself the product founder whisperer for technical founders building enterprise AI. And when he explains it, he has this firepower in him that you can tell. It's obviously not the generic, I help with recruiting talent or I open doors with my network. He's very granular about what he does. And he's the person that can translate between technical founders and product strategy because he's lived it and done it while he was building Superhuman, doing 300 to 500K checks exclusively, technical founders, positioning himself as a fractional founder for that 0 to 1 stage. He's proved it out, right? He was the first check into Parable in 2024, which just raised a $16.5 million seed round a year later. He got in before anybody else saw it, and now they're at a significant step up.
I think it's consistent. What he pitches is what he's done his entire life. If you know his story, his background, he tried to be a founder of his own, right? And he failed. And I think that experience still haunts him to this day. But where Vivek has been the most successful in his professional career is in being that soft tissue between a very technical founder and a customer, that connectivity, and helping come up with frameworks by which you can, as scientifically as possible, derive product market fit from a given insight. I think if I was a founder, I would love to have Vivek on speed dial and work with him to workshop the early stages of my company. Those foundational moments are what builds everything else. And so, again, it's painfully obvious why he wins in the deals he goes after. And guess what? He has a great network. Who would have thought? And I think it's proof that network alone is not good enough, because if you just have a network alone and then I pitch you against a supercharge, well, you're missing the value add. We call it clear right to win. I think that not enough people spend enough time thinking about what is their clear right to win. Or maybe they have it and they don't articulate it well. Most people just don't have it. Most people raise these vehicles because they can do it, not because they should do it.
Another manager doing something interesting with their portfolio construction is SoSo at 43 with Annabelle and Dustin.
I think what's great about 43 is the fact that it's a small fund and there are clear swim lanes. We don't really love multiple GPs. We like solo GPs because at this stage, you have to be able to make decisions quickly And it needs to be clear, abundantly clear how you make decisions, right? So the moment that you add multiple people to the decision-making process, it becomes extremely murky. Who influences the decision? This is the opposite. Early stage investing is anything but consensus driven. The good thing about 43 is that you have 3 separate GPs who bring 3 separate skill sets to the table, but at the same time, they make decisions independently. You have a much broader platform that can help these founders go from 0 to 1. You get a lot more throughput in terms of deal flow. You get a portfolio of 60 plus investments, which is excellent for a $30 million vehicle. And you do it in a way that a solo GP wouldn't be able to do. It's interesting how you're like, okay, there is value. Like in this case, 1 + 1 = 3, where by bringing 3 GPs together, you're not diluting it. You're actually supercharging it. Most people don't do it this way. Most people just bring on 3 GPs and have very complicated frameworks about how to make decision. And then in the end, in those kind of situations, it's always one guy. Again, painful. The other 2 are holding the brake and missing the good ones. It's very interesting in the way that it's one of the few examples that we found where they're not shy. It's a hard story to tell. It's very hard to convince people to put money into 3 separate things going on together. I think it was season 2, Rafa, a similar approach, but not quite as crystal clear. 43, each of the 3 partners can cut a check without consulting it. And that, I think, is just something that's really interesting. It's like, how do you scale it without diluting that first check kind of approach? And how do you scale the platform without necessarily having to have like several people working with a GP, which then becomes an extra layer of drag where that solo GP has to handle his LP base, his founder base, and then a team as well. Where are you going to find the time to actually do the work?
This goes back to season 1, episode 1, actually, but I don't think that there's been a manager as clear about his fund size and why he keeps it so small, other than Pietro at Firedrop. And as we were talking about, fund size does dictate everything. Like, it's your check size, it's your portfolio construction, it's your ownership targets, it's your reserve strategy, it's the number of LPs that you have. And I really like the fact that Pietro has raised really small vehicles, 10 million vehicles repeatedly. I think the most recent one was 15, because he has happy repeat customers and he's doing exactly what he said he would do over and over again. His LPs will commit to him, and by the time he opens his fund on a Friday, he's oversubscribed by Monday. I think a lot of GPs don't necessarily think about the LP impacts when you increase your fund size. It's not just a new set of founders you're investing in, it's also another set of LPs that you're introducing and trying to pitch to. Yeah, and that's how you end up in a cycle of always fundraising.
Because you're churning your customer base with every single vehicle, with every single fund. Pietro, which was our very first episode of our very first season, put it best when he himself knew that at the beginning. It was like, oh, I'm going to do a $10 million fund as a concept, and then I'll go bigger. And then along the way, he realized that the concept was the product itself and that it shouldn't have gone bigger. People really don't realize how important it is to compound into a brand. So if you did a $10 million fund and now you want to go up to 20 or 30 and then 50 and then you want to go up to 75, like you said, you're losing the power of compounding. You're churning LP base at every single vintage. You're churning your founder base and the network of referrals with every single vintage. And you're just not believable to the eyes of a sophisticated LP in the context of, I could have written a bigger check if I wanted to. Then why didn't you do it? Like, why didn't you write a bigger check? Why didn't you do a $10 million fund with 8 positions, like Steel Atlas? People that lack conviction are not believable in saying they could have had the option to do something that they needed conviction to do in the first place, which they didn't show to be able to have. And so in that sense, then stick to what you can do that you know that you do really well. Keep it small, collaborative, and do what people identify you for being good at, which is like super angel, institutionalized angel type approach, which is very different than doing a high conviction, highly concentrated portfolio, or even a traditional seed fund type portfolio, which very few people are capable of doing. Like very few people have the level of discipline and rigor and like ability to do it well. It's interesting. Just recently, one of our managers on their third vehicle went from 20 to 30, and then they wanted to do a 50. And then along the way, they realized that that was not the right approach. And so they scaled it back to another 30, and they're going to stick to 30 for the foreseeable future. Yeah. And because that's their sweet spot, that's what they're really good at doing. And that's what they want to keep compounding into, which we love. They got approval to do that downsize like almost overnight because everybody understood them to be the shit when it comes to that fund size, to the 30. As soon as you push it to the 50, we were like, you're really going to be able to do a good job? Will you really be able to find that layer of institutional LPs that are looking for a very different product than what these guys are buying, that it's a lot quirkier in nature than what an institution would like you to buy? There is definitely variance in the way that people think about graduating sizes, and also in the context of portfolio construction, diligence, and presenting marketing materials. I think a year ago going into this, I would have expected a lot more consistency, given that we were narrowing down on a very tiny niche in a very small market to begin with. And instead, the dissonance, it's enormous.
And you mentioned Steel Atlas just a second ago. I really like how in-depth they were about their diligence process. No other firm we've spoken to has a process that in-depth. That's the type of rigor that brought together Valor's seed round. Mm-hmm. Valor just raised $130 million because they were struggling to raise that seed round, and Steel Atlas put together this 100+ page memo that other firms use as their diligence. They're a different case because they're more concentrated and they can take time with their diligence. If you're writing 100K, 200K checks, you can't really do that. But the principle is still conviction, and you have to understand what you're betting on, who you're betting on, and exactly why you're doing it. Because they only had 8 positions in Fund 1. You have to be extremely detailed and disciplined about which companies you're going to invest in.
We love Talal & Cameron. A lot of people don't love concentrated portfolios. I agree to the principle that you shouldn't be concentrated until you should. Yeah. And I think they should be concentrated. I think it would have been not very good for their first fund, which is a monster vintage at this point. They put their money where their mouth was, and they put their conviction on the table, and they demonstrated that the research-driven approach is the right thing to do when it comes to industrials. And industrials as a category, especially a pre-seed, doesn't move as fast. I think another person that is interesting in that space is Mike from Also Capital. Those are very few deals. They don't move as fast. Most of the capital in those verticals sits at the later stages. There is not as much competition. You wouldn't be able to even put together the kind of diligence that they do, even if you wanted to. Like a round would get done faster in a hot vertical like enterprise AI or something of that sort. So yes, it needs to make sense, right? But then when you meet Cameron, you understand why it makes sense. Not only he was trained at Alicorp, but he's a former college athlete and somebody that spends a lot of time studying, being focused, diligent, and puts a lot of thought before actually putting their thumb on the scale. And then Talal is like the wizard networker, kind of compensating for that more introverted side of the equation. But yeah, you're right. It really brings it home for us whenever we meet this kind of managers. The point is that there isn't a given formula, but there are flavor compounds that taste better than others. And I think that what we've been able to do over the last 12 months is taste a lot of different recipes, and we're deriving what are the flavor compounds that make a great recipe and a great manager. It's becoming easier for us to evaluate somebody even before an intro, just from what's available in the public domain about them. That's what's really the biggest revelation of the last 100+ data rooms that we went through. Let's just assume that all of the hard data points in the right direction, right? You have to assume that's the case. You cannot be good at this job if the data doesn't say that you're good at it. And so what we're looking at is the softer side. Self-awareness is the pattern that we see being the most important ingredient on top of actually being able to perform at a job. And I don't know what comes first, whether it's chicken and the egg, or maybe it's both at the same time, but there is definitely something there, that it's awareness of who you are, what do you do really good at, and what are you going to say no to. Not to beat on Sarah and Vivek, but they had the opportunity to raise much bigger funds, and they purposely say no to that. They probably would have had an easier time raising a bigger fund than raising a smaller one, but they purposely said no to that because they knew that they wanted to play at first check investing. That self-awareness is just like something that you shouldn't take it for granted. Let's put it this way. There is a reason why we only invest in 5% of the pitches.
So where do you think is the opportunity? What's happening in the market right now in the land of early stage funding? Why is it that Sarah and Vivek have the opportunity to build a fund and win at the very first check?
The whole slice thesis comes from the understanding that accelerators are irrelevant. YC may be a tiny exception, but even that's debatable. I would say that what Accelerator had to offer in the past, it's like community mentorship, a little bit of early capital, got unbundled into a distributed network of first check early stage investors, which mostly have an operator background. Different innovations allow this to happen. The Safe Note allowed this to happen. AngelList allowed this to happen. The 2021 end of cycle boom of capital distributions allowed this to happen. We have more operators and founders that have received distributions from their endeavors being able to participate in the value creation process of investing. This is changing the landscape quite a bit. And like we mentioned at the very beginning, the later stages are going bigger and bigger. And companies are staying private forever, which gives an opportunity to like things like Thrive or Greenox or whoever else to deploy several $1 billion at the time. And that makes these deals very juicy and interesting. But there is sort of a missing middle, which is being hoovered up by the tier one platforms. The Sequoias, the Benchmark, and Andreessen, the Kleiner Perkins. As a founder, you want to raise money from these people because there is a reason why they're great at what they do. They are long-term partners. They're actually the best board members there are. They're value add in a way that a no-name VC could never be. And there is a reason why they don't have the reputation, is because they're not good at it. If you're really good at it, you'll be recruited out and you will be joined at the big ranks. At the same time, it's almost impossible to build one of these franchises anymore. It would be the same as saying, like, I want to build a Vanguard or a Schwab in 2025. The time to do those things was 30, 40 years ago. And the time to build a Sequoia was 10, 20 years ago, and to really build it into a brand. You can't compete. The market has consolidated. It's completely saturated at every stage. The only place where it's still possible to capture a glimmer of alpha is the first check. Those very tiny rounds, very tiny checks, very tiny funds, which makes it structurally hard to do a good job at scale. It makes no sense for an individual investor, LP, or family office to do this on their own. It's just too much work. Like, we've met a couple of folks that do this, and they all come from the industry. They are all very well versed in what they're doing. I think that the opportunity remains at the earliest stages. And I think that the true opportunity is like piggybacking off the relationship that these first-time managers build with these first-time founders and their ability to double down once there is some traction, once there is a talent flywheel, once there is a Sequoia at the table willing to invest in these companies. The risk has decreased and the opportunity becomes clearer. But to get into these rounds, you have to have been there from the start. Otherwise, nobody wants you there. The only reason why you get allowed the opportunity to invest is because you took the leap of faith at the beginning. And if you haven't done that, then I'm sorry, you just missed it.
Yeah, we're definitely seeing a lot of AI native teams skip the traditional $2 to $3 million seed round. They want to do more with less. Replit are a good example of keeping the headcount lean and growing rapidly in terms of ARR. And also, if you do scale up your fund size, that means you become a fund competing with the multi-stage platforms for companies that already have traction. You're getting the leftovers from the multi-stage firms.
Yeah, and
Way
Sunwo,
too
how
late.
many, like we see so many data rooms. When did you ever see a breakout success in the last 5 years that was not led by the tier ones?
Yeah.
There is so many, like hundreds of firms that do so-called Series A's that the people are never going to see their money back. Because if the founder was really that good, they would have got money from a tier one.
Before the round is put together. That's always where the alpha lies.
So what does this mean for managers?
You're going to miss the next wave if you're not writing first checks before there's a lead. Founders don't need big rounds anymore. They can do much more with much less capital. So the alpha becomes what you can provide for that founder, which is why former operator and former founders turned investors have a clear value add and are cognizant of the value that they bring to the table. Also for LPs, you can't write checks into the brand name funds anymore. You have to buy the beta version of their main vehicle in order to maybe get a chance later on to write a check into that core vehicle.
Also, you better show up with $250 million.
Yeah, that's a little taste of what we're building at Slice. We're going to go deeper in 2026. IRL events in New York, San Francisco, Austin, Los Angeles, live recordings that function as mini AGMs, where we bring together the very best emerging managers and the LPs who back them.
It's very exciting because I feel one of the things that came out of this year, it's the community that it's getting built around this brand. We definitely punch above our weight class. It's similar to our managers, right? It's not the check size that has built the reputation that we built for ourselves among the managers. We've screened and backed. It's the sophistication of understanding it's happening at their level that allows us to have meaningful conversations. And to bring that into the real world next year, it's going to be very exciting. If you remember at the beginning, we started this thinking, is there even enough manager that would be a good investment for us to build this into a business? I feel the answer is overwhelmingly yes. There is no better way to find more of these amazing people than to have these intimate in-person events. And these are not networking events, please. This is not a let's meet a bunch of LPs. This is probably more of a local maxima of our yearly truffle hunt, spending good time with colleagues in a very open and transparent manner, which is what we want to live by. We just want to be very open and transparent, give very direct feedback. Always, when something doesn't make sense, just be honest about it and call out all the elephants in the room. There's a limitation to Zooms in a way. It's nice to be able to do it in a more convivial settings with people. So very excited about our in-person programming, which doesn't mean that the podcast is stopping, but there's going to be a bit of an evolution, I've been told by
somewhere.
I'm retiring from the podcast game after 3 seasons. We already started recording season 4, and Sunwoo is the host. She's already doing a much better job than I ever done across 50 episodes. So I'm very excited about that. I'm very excited about the next kind of the continuation of the Slice Pod. It's such a good excuse to spend quality time with managers and hear their stories in a way that it's not a pitch. We'd do anything to get somebody out of pitch mode, honestly. And this is just a very easy way to break the ice from that perspective. Now that my newborn is going to be 1 year old, we can go back into our yearly truffle hunt. That will be very exciting to get that back, get that organized again and everything else, and just like meet new managers. I think this is just the beginning. We see new funds getting formed every single week that make a lot of sense to us, probably more than what there was available 2 years ago.
Yeah. I'm definitely excited to see more original managers as well. Maybe it's a function of what's been in the landscape and been just murky and mysterious, but a lot of people just copy what they've seen. The ones who really stand out are building something very original that's true to them. When you look at over 100 data rooms, you see how special it is when the entire story makes sense front to end. Hopefully, we can be a small slice in helping managers tell their stories in a more original manner and be a small part in helping them realize what their unique edge is.
I like that. It's a very founder first approach that we have, that it's like just provide value before you ask anything in return. That's a principle to live by. So, last thought before we wrap on what we've been learning while building Slice is that quality truly compounds. We could have done 50 plus interviews, but we chose to do only 12. Each one was very thoughtful, very deep and well researched. Thank you, Sunwoo. That's what people will remember. In the end, it's not about the volume, it's about the finding and the signal and our job in trying to amplify that signal. We never look back as we're doing things. I asked you yesterday, how many data rooms have we gone through? Like 100 data rooms in 1 year is like 2 data rooms a week. And we go deep on these things. We're not just going through it. We're checking every single position, every founder behind every position. We give those managers the respect they deserve. It's quite impressive. It's so much work and so much that we have learned in such a short period of time. Thank you, Sunwoo, because honestly, you're the one that does most of this work. We would not be here without you. This has been a crazy good start to the Slice adventure. So thank you very much. To you and for all our listeners and fans for being here and having made it to the last minute of the last episode of the last season that you'll ever hear me host.
Thank you for an incredible run. It's been awesome. And the way you think about things, the way you approach managers is so commendable. There's a deep sense of kindness that you have that not a lot of people do, especially LPs. And hopefully Slice can be a small slice in the LP landscape that brings a genuine sense of curiosity, founder first mentality.
If you're an emerging manager who wants to be a part of our in-person events next year, get in touch. You know where to find us. For anyone else, make sure to follow us on slicefund.substack.com. We also have a swanky new website with a bunch of musings. We call them appetizers.
Slice.fund.
Slice.fund. Don't miss it. Thank you all for listening and see you in the new year.